Okay, episode 4 of the bootcamp. We're going to get straight on with this, and I'm going to break down how I see liquidity. So the way that I imagine liquidity is just basically pools of money that are resting in the market. So for the market to move, it always has to take some kind of liquidity, which means it needs to take people out of the market for them to move in a certain direction. That's why trading, for you to win, somebody else out there has lost. Okay, it's kind of a player versus player scenario. So the market needs to take people out and wipe them out of the market for somebody else to be in profit. So the way it does that is in terms of liquidity sweeps and taking out highs and lows. So the way that I imagine liquidity is above every single wick is liquidity. Okay, so above every single candle is liquidity, because every single one of these candles has had orders put into it. So there is a lot of buyers in this candle and there's also sellers. So this 5-minute candle holds a lot of liquidity. The same as this larger one, same as this large one. And obviously the bigger the candle, the more liquidity and the more orders were in that candle. So the more volume per candle. So if you look at what I've just drawn out here, we've got a level of liquidity above and a level of liquidity below. So what that essentially means is that there is a lot of money resting down here, and it's also resting up here. Now, we do not know which side the market is going to take, but all we do is just wait to see what happens. Okay, and from the market sweep and liquidity, that is when we can kind of look for our move. So if you see when I play out, we do actually come up and we take out this top level of liquidity. So the way that it works is, if you imagine, okay, imagine if you were here now, okay. The reason this is a liquidity level is because there is people placing short positions here. So people are selling the market, selling NASDAQ at this level here. And their stop loss may be above this candle, or it may be above here. And they might be targeting, down here, okay? This other level of liquidity. You see all these wicks? So in this scenario, once this candle taps here, okay, we know that their stop losses are above here. So if the candle hits this level of 20881.75, then these people that are shorting are going to be liquidated and going to lose their position. So they're going to lose money. So the market then chases their stop losses. So they go into a little bit of profit, and then it tags them out. Okay, let's say the stop loss was there. It tags them out, and then it goes in the direction. Okay, now that is how the market moves. So essentially, before every big move or before a move, we always want to see a liquidity sweep of some kind. If not, then you're probably going to be the liquidity, okay? And if you've ever heard of that saying, it's essentially what people say when you've lost a position and you were the liquidity for the market. So these people here were the liquidity. So the people that were shorting from this scenario right here were the liquidity for this downward move. Because you see, once they get liquidated, so once they hit stop loss and lose the position, what does the market do? It goes exactly where they wanted it to go. And that's what happens 90% of the time, okay? Whenever you get liquidated, or whenever your trade hits a stop loss, you'll very often find that, obviously if you had the correct bias and you had the correct idea, that the trade will in fact go in your exact direction. And that's one of the most infuriating things, but it just means that your entry wasn't refined enough and you weren't patient enough and you didn't wait for a good enough entry. It means you've rushed your entry. So here, there was no liquidity sweep. I mean, we took this high, but there was no real sweep. This here is a much clearer sweep. We swept out all of this, and then we go in the correct direction you wanted. So this works for any single time frame. So if you just imagine, above every single candle there is liquidity, and that is the basics of the liquidity. Now, what we need to speak about as well is there is a lot of different types of liquidity. Okay, now this is where you need to be writing down this if you're going to learn. You really need to be paying attention to this. So I just taught you about each individual candle is its own set of liquidity. Okay, so this candle here is a liquidity level. So if we sweep out that high, or if we sweep out this low, then of course these are key swing points in the market. You see how obvious these are compared to, this candle here. This one isn't as obvious as this, okay, or this one. Okay, they're all liquidity candles, and there's always money above and below each one. But the ones we're interested in, and you should be interested in, are the main ones in the market. So here is a clear level of buy side liquidity. We call it buy side when it's above, and sell side when it's below. That's the way I remember it. And If this gets swept, then you could probably look for a move lower. The same as if this gets swept, you would kind of expect this to get swept as well. Okay? And if this gets swept, then you could probably expect this to get swept as well. So what I would be looking for personally here is if we did come down, I would be looking for us to take this out, take this out, take this out, and then see some kind of reversal. Okay? That would be my kind of entry model that I personally use. But of course, everyone trades differently. Now, what I need to touch on is that there is different types of liquidity. So this here is just a resting swing point, a swing level of liquidity. What a swing level is what I taught you before in the market structure. So each one of these highs and lows is a swing point. So that's a swing, that's a swing, that's a swing. You get the point, okay? So every single high and low is a swing. If I draw that out for you to make it a lot clearer, you've got a swing point, you've got a swing point, you've got a swing point, swing point, swing point, swing point. Here's probably a bigger swing. Okay, you get the point. So it's basically just every single low, high, low, high, low, high, low. You get the point. So that is a swing level in the market. Now, there's other types of liquidity, which I'm going to touch on now. The main one that I usually use is equal highs and equal lows. So what that means is when we have got two wicks that are the exact same place in the market. Now, the way that I identify these is by using an indicator. So if you come up here in indicators, type in equal highs and lows by out of options, press this, and you should have something that looks like this. Okay, and this black line here is indicating to me that these two candles are equal highs. So you see all those two wicks there are exactly equal. Okay, they are literally touching the exact same point. That is an equal high, and of course it's the same with equal low if the lows. So what I use these for is a strong draw on liquidity. So if we drop down to 1 minute now, you'll see a lot more, because on the 1 minute there is going to be a lot more equal highs and lows. So you'll see here now that down here, the indicator, has identified that we have got equal lows there at 2770.25. So if I was looking for a position here, I would be looking to target these equal lows as it's like a magnet on price. That's how I vision it. So when I say a strong draw on liquidity, I mean it's basically like a magnet for the price. So what I would be expecting here is for the market to come down. You can see it's took out that level of equal lows and it's just about to take out those. I would expect it to come down and eventually get pulled towards these equal lows. And then because we haven't got any more, I don't think, okay, we have got a few more, we may eventually come all the way down and target all the equal lows. And this isn't always the case where it has to come to these, but it is a strong draw on price. So for my personal trading strategy, I like to use these as my take profit levels. If there is equal highs and lows, I don't go against them. So what I mean by that is, let's say we were here in the market, okay? Now, what most people might be doing here is waiting for some kind of entry model to target a long position. So they might want to buy the market here and target these equal highs. But what I don't do personally in my strategy is I don't go against equal highs or lows. So you see how we've got equal lows right there, okay? And I'm trying to target up here. What would make more sense if there was a magnet in price up here? So let's say this is a magnet, and down here is a magnet. Where would you think the market's going to go first? Okay, you would think it's going to come down here, okay, because it's closest to this magnet. That's how I kind of envision it when I use equal highs and lows. Of course, everybody's different. They might think that's a load of rubbish, but that is personally what I think. So ideally, what I would like to see, if I was going to look for a buy, is for us to come down, take out this magnet, okay, and then we may start reversing to target the highs. That is what I would like to see if I was bullish. Now, that is essentially the basics of equal highs and lows. It's a very good draw on liquidity, and I use them every single day in my trading. Now, another pool. Now, the last type of liquidity I want to talk about is liquidity pools. So what that means is basically a key area in the market where there is a lot of liquidity resting. Now, this can be in form of a trend line, or it can be in form of a lot of lows, so relative equal lows. And I will explain it further now. So here is a good liquidity pool that we've got on the screen right now. And basically, all you've got to imagine is a lot of liquidity in one area. That is what liquidity pool is. So the way you identify these is by looking at the market and seeing where are there a lot of wicks in one area. You see how we've got like a key level here where we are just suddenly bouncing from for no apparent reason. Okay, and all these orders are getting filled around this area. Okay, now if all these people are entering long, which you can see we've got a bit of bullish price action, we come back down, more bullish price action, where do you think their stop loss is going to be? Okay, it's in this area somewhere here. So you've got to imagine that a stop loss is directly correlated to money. So liquidity is stop losses. That's how I see it. So if you enter a long position there, your stop loss is here. If you enter a long position there, your stop loss might be here. Someone might have entered a long position here, and their stop loss was below. You get the point, okay? Now, all of this is just building up one big pool of liquidity where a lot of people's stop losses are resting. That's how you see it. So it's like a big clump of stop losses. And that is essentially it. So here you can see all these different wicks are just above each other, okay? So below is a lot of stop losses. So here, if the market manipulated down, it would take out all of these people, and then it will probably do this, okay? Because it's took those out of the market, and then it will go in the right direction, like I said earlier. Now, these should be so easy to spot. They aren't complicated at all, so do not think this is complicated. It's basically personal preference, what you identify as a liquidity pool. I mean, it's all personal preference. Like, there's no one that can tell you this is or this isn't. It's all opinion based. But you should be able to just look at the chart and understand. Okay, there's a lot of wicks. So here is a liquidity pool. Okay, resting above here. Why? Because you got 1 high, 2 high, 3 high, 4 high, 5. Okay, you got 5 different highs, all here. Okay, and we see a big push down. So you see what the market does? It comes back up. It sweeps out this low. Okay. So that there is a liquidity sweep. So you see how these people were longing. Their stop loss is below. Look what happened. Okay, they went into a bit of profit, and the market then reversed back on them, took them out, and then look what happened straight after. Exactly where they wanted it to go. So what we wait for is the liquidity sweep, and then we find an entry model to target the highs. Okay, do you get my point? Okay, now those 3 are the ones that I use in that order. Are the strong draws on liquidity. So in my strategy, I only look for equal highs and lows. If we haven't got them, then I'll target a swing point. And if we haven't got a swing point, which we always will have, but I will also target a liquidity pool. I just want to touch quickly on the liquidity pool in form of a trend line, which is what I just mentioned. So you can see here that if I pull it back to this scenario, can you kind of see the trend line that we are forming? Now, what a lot of people do, is when they first learn how to trade, they type it on YouTube, easy strategy, and the majority of strategies that people put out there are trend line based. And that is because it's extremely easy to notice. My mouse has suddenly stopped working. Okay, so the last form that I want to speak about is in terms of a trend line. So what a trend line is essentially just a line that price bounces off and follows. Now this here is one of the easiest liquidity pools to possibly notice. Okay, because retail traders and beginner traders love to use trend lines, and they always get wrecked. Okay, at some point they'll always get wrecked. Now, what I mean by wrecked is they'll get swept out of the market. So the way you've got to view a trend line is that below every single one of these lows is money. Okay, so above here is money. Below here is money, sorry. Below this low is also money. This one here, because people are longing every time it touches a trend line. So you've got to understand that below every single one of these lows is money. And it just follows all the way up. And what do you think this is building? Okay, this is just building a humongous magnet. Okay, a huge magnet that price will eventually come and absolutely destroy. So if we play it through, and eventually, okay, there we go. Eventually we will absolutely fly through it, okay, and take everybody out. And you'll see we come down and we take out the exact low of the trend line. So that means all of this trend line has now been swept, and look how fast and volatile it does it. So this here is just one of another good draw on liquidity. If you see a trend line, then I would not be taking a trade in the direction of that trend line. I will be doing the opposite. Okay, so here you can see a bullish trend line because we are going up. So I would be looking for short positions because I want to target this liquidity pool. It's the same scenario for a bearish trend line as well. So here we have got a bearish trend line. You can see we've had 1 tap, 2 tap, 3 tap, 4 tap. We were just about to make another leg down and it gets swept. That is episode 4 complete. On episode 5, we're going to be going over fair value gaps, which is one of the key components in my strategy. So make sure you tune in for that one. Turn on post notifications, and also don't forget to join my free trading Discord, which is in the description. That is where I currently teach my active students, and I also trade live every single day using the model that I'm about to teach you on this bootcamp. So yeah, thanks for watching, and I'll see you on the next video.